Most investors think their portfolios are diversified. They look at their statement, see 2 or 3 pages of holdings, and assume that equals diversification. The reality, unfortunately, is that many investors, regardless of how many holdings they have, are not diversified and are simply making the same bet over and over. Without question, the big bet we most often see today is an over-concentration in US stocks, specifically US large cap stocks. Investors have a natural home country bias, but couple that with the fact that US markets have performed incredibly well over the last decade, and it's just become very easy for investors to stick with familiar companies and to forget one important fact. The US is just one country in a very big world. US markets actually did well again last year, but to many investors' surprise, international markets, shown here as the blue and green bars, handily outperformed. We've talked about the need for investors to invest beyond the US for a long time, but recent performance has finally helped that message resonate. As we discussed last quarter, we don't think it's too late for investors to diversify into international stocks. Valuations are still attractive, but we'd argue that the long-term diversification benefits make an even more compelling argument. And that's what we want to focus on today. Diversification isn't just about owning a lot of stocks. It's about owning different stocks that don't all move the same way at the same time. Despite their many differences, US companies are all influenced by US interest rates, US politics, US consumers, and US economic cycles. International companies aren't immune to what happens in the US, but they also have their own country dynamics, their own economic cycles, their own political shifts, as well as different demographics and currencies. Investing both domestically and internationally shouldn't be about trying to pick the winner between the two. It's really about reducing risk. When one market struggles, sometimes another thrives. And that's what diversification is about. Okay, so what's the right amount or percentage of equities to have in international stocks? This simple chart from Vanguard does a good job of showing how this works. On the x-axis is the percentage of a portfolio's equity allocation invested in international stocks, ranging from 0 to 100. On the y-axis is the impact to portfolio volatility. As the percentage in international stocks increases, volatility initially drops. Most of the benefits can be captured in the first 20 to 25%, but they continue to climb until you get to about 40%. We'd argue that investors at a minimum should have at least 20% internationally, but obviously a graph like this makes a case for as much as 40% just on the expected diversification benefits alone. Unfortunately, we know that many investors today are nowhere near even that 20%, as many have little to no exposure at all. There are a host of reasons why, but all too often investors get caught up in trying to predict the future and end up constructing a portfolio that relies entirely on that prediction being accurate. Being diversified and investing in areas like international stocks is in some ways the opposite of that. It's about acknowledging the future is impossible to predict and building a portfolio that's prepared for whatever the future holds. Thank you for watching. If you want help thinking through the right allocation for your goals, timeline, and risk tolerance, please contact us at the number or email shown at the close of this segment.